Hey everyone, welcome to Dr. Frank's Finance World. I'm Dr. Frank, the bank, where I try to teach you something about finance so hopefully you can make money on the future. We're at part two of options out here. And by the way, hit subscriber notifications if you want to get notifications. It's going to be around 80 videos now and a whole bunch coming in the fall as I work on more courses and stuff. But anyway, I try to put notes in the links about websites and so forth. So from an option standpoint, a call option is the right to buy the underlying financial instrument at the exercise price or stock price within a specific period of time, which is the date that you choose the strike date. It is in the money when the market price is above the exercise price. You can force them to sell it to you at the exercise price, and when the market price is higher, you can turn around and make money. It's at the money when the two are equal, and of course out of the money when the market price is below the exercise price. From a put, you have the right to sell or put your financial instrument, your shares, at the exercise price onto the seller out there within a specific period of time. And options always have to pay off within a specific period of time, which is why they can actually be risky out there if nothing happens in that period of time. It is in the money when the market price is below the exercise price, because you can force them to buy it from you at something higher than what the market is. In the money when they're equal, out of the money when the market price is higher than the exercise price, because you'd rather just sell it in the open market than take a lower price for it. Biggest mistakes: don't do homework on the security. You have to look at when their dividend dates are, when their dates are for giving earnings announcements, and that type of stuff out there. You need to know something. You're just guessing if you don't know, because like I said in part one, why are you buying it? If you don't know something is going to go on, why are you putting your money at risk? You also have to watch for low volume. One of the biggest losses I took in my investment life was dealing with low volume options out there, and I didn't realize at the time how low they were. But the bottom line is, for stocks, it's important. For options, it's absolutely critical. Because if things don't go your way, you might want to sell the option, at least I do, before it gets to the maturity, because I'd rather walk away with some money than none. But low volume is the hex that you will take on options if you're not careful. Counterparty risk. The options clearing corp out there will take care of that, so no real worries as long as you stick to standardized options. The vast majority of option volume is maybe 50 to 75 stocks and indexes. You'd be surprised out there. It's a smaller options world than you think, and when you look at it, due to the timing issues and technical analysis and so forth out there, you may be able to help yourself. You only have a certain amount of time before the option expires, and the fact that you can do technical analysis to figure out whether it seems to be expensive or seems to be cheap is one way of perhaps putting the odds in your favor. So volatility, you can consider implied, which I said in part one, is backing into what would make the sense for the price right now, or calculated. I do calculated. I've done it both ways. I don't see a whole lot of difference, but I know what the calculate makes me feel better than I know what's happening behind the math. Is there help to figure out value? To some, whether it's a good price to pay for how long it's going to mature, to some degree there is. I haven't seen a whole lot of modeling that's free out there. One of the things about the paywall, it's the first time I'm putting in a paywall on Dr. Frank's Finance World, is options. And the reason why is because you can make so much money if you happen to get things right. And it really matches up with my concept of investing, which is trying to put the odds in your favor. So details in the quick course, is a checklist out there with that paywall, is other value, the in-depth process, including how to find stocks that might play and whether they are undervalued or overvalued for options, and the strategies to make money. We actually run Z-scores on that to figure out the probability of payout. Also working on an AI model on that as well. The Excel model to calculate both the probability of payoff and a stack valuation model out there. Somewhere we're going to draw the line, especially some neat stuff we're working on now, where you could just go and look up what are your best options out there, your best chances out there, are going to be behind a paywall. There's just no way of avoiding it. I feel like there's so much money to be made in it I can't afford to give you all the secret sauce without making something for 30 years of effort. So anyway, that's out there. This is really about the basics and so forth. Part three of this, we're not there yet, but part three of this will have problems that you might help to understand how options are valued, but more realistically, it's helpful with problems that students might see on exams because I still teach. What do the payoffs look like? I think visually looking at what is the chances of you making money, or at least what would have to happen to the stock for you to make money or lose money, is an important part of the game. So call options, I think, are the easiest one to understand. In this situation, you have the stock price over here. You paid, and I'm sorry, you have the option price out there. The stock price is down here. So the $60 price for the stock, 70, 80, 90, and so forth out there. This apparently had an $80 strike price because that's when you start getting your money back. And you paid a whopping $14 for it, which is quite a bit for an option. Really, with 100 shares, you paid $1,400 for each one. And at $80 and above, on a call option, you actually start to earn your money back. So it's going to be in the money for anything above 80, but you haven't achieved break even until you get the strike price plus what you paid for the option. So $80 plus the 14 you paid for it means at 94 bucks you have your money back. And wouldn't it be nice to know what the odds of that happening are, at least probabilistically, based on recent movement in stock prices? That's where the paywall stuff comes in. But at any rate, at 80, you start getting money back. At 94, you've gotten all $14 back, at least if you were to exercise that point in time. And the person who sold it to you has now lost all of that $14 premium. From this point forward, you're actually putting money in addition to your premium in your pocket, and the person who wrote the option is losing money. That's why on the exact same situation, the payoff for the call writer is they got your 14 bucks, and anything below 80, they keep it all. As you start to go higher in price, they're starting to give your money back. At $94, the stock writer has lost all of the premium and is at break even, just like the purchaser is. And anything above 94, they have to pay off the other person, and therefore it becomes a more expensive venture for them. Keep this in mind. Call writers out there, especially when they don't own the underlying security, have unlimited risk because the stock price, in theory, could just go up and up and up, and they would have to cover it. What about puts? Well, puts, the idea is you put money down and you would have to, in this case, $2 on this one, and you're basically buying as an insurance. So let's say the stock was at 40 bucks and you're afraid it might go down in some period of time. So you went ahead and paid $2 per share, or 200 bucks, to get your money back out here. And from the point of 40 or above, you would not exercise it as the buyer because you could simply go sell it in the market for more than you could make them buy it. But somewhere in here, you're actually looking at break even, getting your money back. And any drop in stock price below that, you're actually going to make money on the put because they're going to have to pay more for the shares than what your money down was and where it's fallen. So this is a little bit index one, so it's basically one of the big indexes out there. But at any rate, might be, for instance, the S&P out there, SPY. But at 400 bucks, basically you've put your money in, and anything above that, the person who bought or sold you the put gets to keep your 400 bucks, $4 for 100 shares. And as it starts to go down, below 400, they have to make up the difference, and therefore they're handing your 400 bucks back. Anything below there, they are actually losing money. So that's what the payoff looks like. Anything above the 400 strike price, they're going to keep all your money, and then they'll keep handing it back as it goes lower and lower. Option oops, I call them out there. Dividends are not really incorporated well into options. So be careful of companies who pay dividends. Obviously, it's going to typically lower the stock price, but dividends can be part of the options equation. And you need to know, especially if you have big dividend paying companies, when those are, so you don't hold the option at that time and lose automatically because the shareholders got some of their money back. Watch for earnings announcements. Maybe you buy them because of the earnings announcement, what you think might happen, but keep in mind earnings announcements will typically create extra volatility around the price as well. Too little volume, that's where I've been hurt, and I think people don't pay enough attention to volume or liquidity of really any financial instrument, stocks, indexes, whatever. And then too far outside the money, a lot of people go like, wow, I can control a $400 SPY for 50 cents. Well, you can, but it has to move so far before you make money. It's so far outside the money, the probability of you making money on it and getting your 50 cents back is very low. So this institutional use out there, very, very big. They're big players in the options games out there. Although option positions are sometimes taken by institutions for speculative purposes, they are more commonly used for hedging, particularly banks and so forth. What is hedging? Go check it out on Investopedia. It's essentially insurance when it's all said and done. So, speaking of a book on it, Follow the Smart Money by John and Pete Najarian. If you go look on the books part of Dr. Frank's Finance World, you'll see it. They specifically look for large volume changes in options and try to determine, what bet is somebody taking out there that will make a difference. So, interesting book. I think a very good one. And the smart money is, in theory, the big institutional investors. So don't forget to send emails with comments and for Ask Dr. Frank. And I appreciate you. We'll talk to you next time. Bye-bye.